Hey everybody and welcome back to another video. This is how to invest and this is going to be on a new stock. This is Chewy. They are a online kind of omni-channel pet food supplier. They're a big competitor, I guess, with Amazon, and they're really just kind of trying to cut out the middleman of the grocery store and not having to carry around those huge, like 50-pound bags and trying to get them into your car, because a lot of the pet owners are older, or maybe just don't like it or just find it easier to have it shipped directly to their house. And they offer really good discounts and deals. I think they also do like toys and other stuff as well, pertaining to pets. But this stock caught my eye because it has fallen quite dramatically. You can see here over in the 1 year chart, just on the quick section, it's fallen just about 50% from its highs and is at $63 currently. The market capitalization is $26 billion for this online pet food supplier. We will get into some of the stats to see if that is overvalued by typical metrics. We can see here that their trailing PE is skyrocketed, almost as high as you can get. Well, not almost, but one of the highest valued stocks on the stock market. And then their forward P is substantially lower. Their forward P is actually pretty reasonable for the growth rate at which a lot of people think this company is growing at, and believe it will be. But that is yet to be seen on a consistent basis. So it's at 200. Just to keep in mind, the average currently is around 23 to 25 for the S&P 500. And if we get down to see if that's kind of justified due to their growth rate from their quarterly results, we can kind of see if they're worth that. Because as you guys may or may not know, companies that are or have a higher growth rate typically deserve a higher price to earnings ratio, and a lot of the kind of ratio driven ways to value a stock. So currently, from the last quarter, they earned $8 billion, which is a substantial amount of money for their market capitalization just in the past quarter. If you extrapolate that out to the year, that would be just about $32 billion. So that's higher than their market capitalization, which is very, very high, or would be a bullish point if they would be able to continue the growth in their revenue. Their gross profits was almost $2 billion at $1.8 billion. So a lot of this is hitting the bottom line for being an early stage growth company. We can see that their year-over-year growth doesn't really exist because they weren't earning money on the bottom line last year, which is why this is non-applicable. But just before we get down to their balance sheet, I did want to point out that their margins are almost as small as can be currently. This is because they're really trying to price out a lot of the competitors currently and take hold of market share and keep them for a long period of time. And as they keep the market share and keep the customers, they will essentially earn more pricing power in that way. It's a good way to get your foothold into really any business or industry. It's a pretty common practice. I'm not sure if this has a name, but a lot of people do this. I can't think of any other companies that come to mind, but they come in with a lower price point than most companies that are in that field and really trying to drive a lot of people out of the market share, take hold of the customers, and then as their business becomes more and more efficient, they can improve their margins, which will improve their revenue. Well, not their revenue, but their profit and what hits the bottom line, and will eventually improve the company, and they can increase prices because they have that market share and pricing power due to loyal customers. So I just want to get that out there, that their margins are quite low currently, but will look to increase quite quickly over the next coming years. But I will say other online kind of e-commerce plays really don't have that high margins in general. If we look at Amazon, they're still looking to grow substantially, and they are, but their margins are only 6.5%, which is quite low, considering Amazon typically likes to be traded as a tech stock, which tech stocks typically have margins exceeding double digits and are closer to 20%, if not in most cases more than 20%, because they're offering online services which can be created cheaper. But without further ado, we'll get into the balance sheet and see how well their financials are. Currently, they are able to pay off all of their debt and still have quite a bit amount of money on the balance sheet, about 325 or 330 million still left. So they would be able to keep operating their business and their cost, or maybe acquire a small acquisition, but I don't really see acquisitions too important for this company. I really think they're trying to build out their supply networks and really improve margins from economies of scale over the long term. But I wanted to make this video because I said earlier it has fallen quite substantially, and it is typically overvalued for about 25% growth for the revenue. We don't really have a number for the earnings because they weren't earning money on the bottom line last year. But I wanted to make this because from a technical perspective, this stock or chart is looking very, very attractive and increasingly more attractive over the coming days. So I think anytime a stock is considerably overvalued or undervalued, that the best way to try and essentially find out how much the company is worth is going into the technical analysis and seeing what people want to pay for this stock over a given period of time. So that's exactly what I've done here. And these lines are kind of my thoughts visualized onto the screen. They're not really technical analysis that maybe anyone else uses, but this is what I'm seeing, and I'm going to try and convey it to you guys. So this is from about the past year, maybe year and a half. We can see that it had a little bit of consolidation in the summer of 2020. It was stuck around the range of 48, went a high of, I guess that's 51, so it was around 3-point range, and was kind of bouncing around there for 2 months, and then it kind of broke out up into the 70 range, had a swift correction back down, and then from there had a monster run all the way from 50 to 120. If we pull up the chart a little bit, we can see it hit a high of 118 or 119.63. So very, very close to 120, which is a very, very good move in just a matter of, you can see here it started in September and went until February. So that's just 5 months. A very, very good move, almost a triple. From there, we had a very, very hard sell-off in March of 2021. We had consolidation from March until April in the sort of 80s range, where people were like, whoa, this stock got sold off so quickly. Chewy is such a great stock. I want to buy this and hold it for the long term. We had a lot of down and selling pressure or downward pressure in the market. I think it was due to inflation fears in May in general, and basically everything sold off in May. So this isn't a surprise to see, but it touched right here, right around $65. And that is a good range of consolidation back in from October until November of last year. So for about a month, it hung around the 65 range. And then we had a very swift move upward from 65 to 95, of 50% upward move within from May to August. So just within 3 months, 50% move. It's phenomenal. 50% for a year or even 2 years would be a good for a stock, let alone 3 months. But from there, we have had a very, very hard correction again. Now, this isn't alone. A lot of stocks have sold off these since the beginning of September, mid-September into October. And I drew just kind of a trend line here. We can see that it has fallen just about 30% in 29 trading days is what the bars mean, because because we're on the daily chart, and we have broken into, I'm zooming out by accident, I meant to zoom in. We have broken into this channel here, and I drew the trend line short on purpose because if we do continue to break above and break this trend line, then this will be a bullish upbringing or breakout for the stock. And I will think very, very heavily, and at this point I'm pretty certain that I would initiate a position into the stock if it is to my liking. But if it does continue to break down to under the 62 level, which the second line is at, I drew that from the consolidation that we had at the bottom of the range from October to November of last year, where we saw a good amount of consolidation and some of the longest consolidation that we've had in the stock, just considering that it's been quite exponential. And anytime you have consolidation, it really shows that there's a hard debate on how much the stock is worth and how much people want to pay for it at that point in time. And they're saying, oh, well, should it go higher? Should it go lower? And a lot of people are genuinely confused and don't really know how much it's worth and where it will be going. But drawing some of these lines can help you initiate what direction the stock is moving. So we did have a hard break off of that 62 line, about 6. But you never know, could fall back down below. So this is what I was talking about earlier when I said that technical analysis can be some of the most beneficial way to value a company. Because by a price to earnings ratio, this is a 200 price to earnings ratio stock, or PE. And even if it fell down another 50% to $30, it would still be 100 price to earnings, which is still 5 times the market average, if not more. Because a lot of stocks are quite frankly undervalued, such as the banks and a lot of industrials. But we can see here that people are willing to pay this price for this stock. And that price is the end-all be-all when it comes to stocks. A lot of people do try and debate a lot of the finer-tuned statistics about, well, this company's earning. Well, what are people paying for the stock? That's all technical analysis is. And from a technical analysis, it looks like people are starting to say, all right, this is getting too cheap for this stock. We're going to have to start buying it again. They might not even want to, but they're just saying that, wow, that's really, really undervalued. I got to get back in, add more, buy the dip. But I think that either way, it's a pretty good deal in this channel as we continue. And if it falls down here, then it will be a great buying opportunity. In my views, I don't think it will break through this box just because we do have good support through this range and very, very good consolidation from over a year and a half ago. But you never know, things can change, and maybe the company takes on a lot of debt that's unexpected. But that is very, very unlucky. And if you made it this far, thank you very, very much for watching. I do appreciate each and every view and like and comment. But thank you, and have a great day.